You are listening to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. I'm excited to bring you in the second and third segments of today's program a conversation that I had with investor and author, Mr. Jim Rogers. Jim founded a hedge fund back in the 70s, did extremely well. He is now an individual investor and author. His insights are terrific, and I know you're going to enjoy the conversation I had with Jim in segments 2 and 3 of today's program. Let me also remind you that this is the month of May, so I do have another special report for you. This month, I have the Probate Avoidance Guide. To get a copy of the Probate Avoidance Guide, along with some bonus information, including the revenue sourcing book that contains a retirement planning strategy for today's economy, as well as the little black book on Social Security maximization. And I'm going to talk more in this segment about the Social Security Trustees report that was just released. Some rather shocking news in that report. But to get all the information, the Probate Avoidance Guide, the books, and other bonus information, I'll send it to you in a big box via U.S. mail. Absolutely no cost or obligation, just another resource for you to consider. Just go to requestyourreport.com. Let me know where to mail that information. I'll be glad to do so. Again, the website is requestyourreport.com. So did you happen to see the most recent Social Security Trustees report? Now, if you go to retirementlifestyleadvocates.com and click on the newsletter dated May 13, you'll see that there is a link to the entire trustee report, which is a 277-page document. Now, the report contains some rather shocking news. The report states that the Social Security Trust Fund is expected to be depleted in 2033. 2033. I did not misspeak. That is just 9 years away. Now, James Hickman wrote a piece for Shift Sovereign, and he had this to say about it. Social Security's annual trust fund report was released yesterday, and no surprise, the report states very clearly that the trust fund balances are projected to become depleted during 2033. That is a quote from the report. Quote, are projected to become depleted during 2033, end quote. This is a fact. This is not some wild conspiracy theory. Remember, the annual report is signed by top government officials, including the United States Secretaries of the Treasury, Secretary of Labor, and the Secretary of Health and Human Services. Now, in my newsletter, I published the cover page of the official report. And there, at the very top of the page, is Treasury Secretary Janet Yellen's signature. Now, Hickman makes some very interesting observations about this report. I'm going to give you just a bit from his article. Hickman concludes that if you dive into this report, if you dig into the 277 pages that comprise this report, you quickly notice that even such a grim forecast, according to Hickman, in fact, may be too optimistic. Here are some of the assumptions that are used in the Board of Trustees report. First of all, they assume, and let me tell you that after 30 years in the financial industry, I can tell you that using assumptions are dangerous. Why? Because from my experience, assumptions are never correct. So if you're going to use assumptions, it's certainly a lot smarter to use conservative assumptions than it is to use an assumption that is overly optimistic or too rosy. Well, that's exactly what the Board of Trustees of Social Security, in Hickman's opinion, have done here. They assume the U.S. fertility rate will be 2.1, which means 2.1 children born per woman. But here's the reality. The U.S. fertility rate has been falling for decades and just hit another all-time low of 1.6 children per woman last year. What does that mean? Well, the actual fertility rate is about 25% lower than the projected fertility rate. That means that when these babies reach working age, there will be 25% fewer of them paying into the Social Security system than the Board of Trustees are projecting. Now, of course, that could change, but again, my point is this is an overly optimistic assumption. Now, there is another assumption. Hickman puts it this way, quote, they're also way off on other assumptions like economic productivity. They assume that productivity growth will average 2%. Last year, it was just 1.3%. And in 2022, productivity actually shrank by 1.9%. Hickman also adds they're way off base in their assumptions about inflation, unemployment, and more. Plus, Hickman adds, just like the Congressional Budget Office's or the CBO's long-term projections about the U.S. economy, the Social Security trustees don't account for any kind of future emergency, pandemic, recession, depression, war, financial crisis, or debt crisis. Now, let me ask you this. Is there any way we avoid a debt crisis? National debt, $35 trillion. Total debt around the world, private sector and public sector, $340 trillion. The Great Depression was arguably brought on by debt excesses. At that time in the United States, private sector debt was about 140%, a little bit more than that, of the U.S. economy. Today, private sector debt is about 220% of the U.S. economy, or more than 50% higher. Can we really avoid a debt crisis? Now, Hickman says the really ironic part is that the trustees' assumptions fail to consider the future economic impact of Social Security going bankrupt. He said, think about it. When Social Security's trust funds suddenly run out of money, it's going to trigger a major crisis in the United States. Clearly, this will be disruptive and throw off their rosy economic assumptions, but they don't account for this either, according to Hickman. So what happens if nothing changes and 9 years gets here? And it'll get here quickly. Well, retirees' monthly benefits, according to Hickman now, and there's 70 plus million of them, they're funded from three sources. The first is payroll tax revenue. If you go to work, you have money withheld from your paycheck for Social Security tax and Medicare tax. The second source of funding from the program is investment income from the trust fund, and the third source of funding is the trust fund itself. Now, starting in 2021, Social Security's annual costs now exceed the combined payroll tax revenue and investment income. So the program had to start dipping into its trust fund. And is this trust fund there? That is another discussion for another day. Right now, when you look at what the report says, once the trust fund is drained, again, all conversations about the trust fund aside, the report says that retirees would have to see a cut of 25% of promised benefits because that is all the tax revenues will fund. So when you look at this report, it's clear that the time to take action on Social Security is long overdue. Yet, when you look at the actions of the majority of the politicians in Washington, you don't see a lot of action being taken. You do see politicians insisting that Social Security will not be cut or changed. Of course, that depends on which politician you're listening to. Now, after the recent report was released, the Biden administration released a report stating that, quote, Social Security remains strong. I have a link to the statement from the White House in my May 13 newsletter. Now, when you click the link and read the statement from the White House, Biden is proposing making Social Security stronger by making the wealthy pay their fair share. There's only one problem with that solution. It's not a solution at all. It's rhetoric. Rhetoric does not solve financial problems. You just need to look at the state of U.S. government finances to prove that. The current outlay for Social Security is just about $1.4 trillion a year. In 9 years, there will be just enough Social Security tax revenues to pay 75% of the promised benefits under the rosiest of assumptions. That'll be a shortfall of $350 billion per year. If you add that shortfall to interest on the debt that will reach $1.6 trillion annually by the end of the year, continued deficit spending of $2 trillion a year, you could confiscate 100% of the wealth of wealthy people, and you still don't solve the problem. Now, I'll talk more about this in the last segment of today's program, but as I go to break, let me remind you, if you've not yet done so, I do have the May special report. It is the Probate Avoidance Guide, and you can also, when you request that report at requestyourreport.com, get copies of the revenue sourcing book as well as the little black book on Social Security maximization. The website again, requestyourreport.com. I'll be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I have the extreme privilege of talking today with author and investor, Mr. Jim Rogers. Jim is a returning guest, having graced us with his presence on the program here a couple of years ago. And Jim, welcome back to the program.
Oh, Dennis, I'm delighted to be here. Where are you?
I am located in West Michigan.
You're still there? Okay.
I'm in West Michigan. And as we're recording this, it is 10 a.m. in Singapore and 10 p.m. in Grand Rapids, Michigan. So,
well, it is 10 a.m. in Singapore, yes. So I guess you have to go to the disco soon. So let's get on with it.
Here we go. Oh, well, Jim, just give the listeners, if you would, please, your analysis, your take on the real health of the world economy.
Well, everything collapsed in 2008, as you know, and then after that, governments around the world, led by Washington, printed and borrowed staggering amounts of money. Nearly everybody did it, and it has benefited. I mean, Dennis, if you give me a couple of $1 billion, you and I'll have a very, very good time. I know how to have a good time with a lot of money, and so does everybody else, and that's what's been going on. I don't think ever in world history has so much money been printed or borrowed or spent. And so things are great. Look out the window. Everybody's having a good time. It's the longest in American history without a big problem. But I'm beginning to see potential signs of problems. I'm not selling short or anything, but it's not going to last forever. At least it never has.
So, Jim, what would your opinion as to what this end game ultimately looks like? You've got the U.S. government spending on a deficit basis of about $2 trillion a year. The Fed has said they're going to hold tight, but what's the end game here? I mean, this can't continue. So what does it look like when it ends?
Well, Dennis, I'm afraid that not many people other than you and me and maybe a few others have calculators or can add and subtract. I don't see any human way possible for the U.S. to pay its debts or even calm its debts someday because the numbers are just so staggering. And I don't know if anybody in Washington can add. I know they're not very smart, but I don't know if they can add. And I don't see an end game. I see an end game of the next time we have an economic problem, it's going to be the worst in my lifetime. 2008 was bad because of so much debt. But Dennis, since 2009, the debt everywhere, even China has a lot of debt now. So I don't see, all I can see is the next time we have a problem, it's got to be horrible. I don't see any way out of that.
But Jim, does this look like a hyperinflationary situation to you? Or do you think cooler heads prevail and we end up with a deflationary environment similar to maybe like the 1930s, if I'm not putting words in your mouth?
Well, you ask a very good question, and I'm not quite sure. The easy way for them would be to print a lot of money and try to inflate our way out of the problem. That seems easy. That sounds easy. Well, to them, they're simple people. Obviously, that is not the soundest way, but I would suspect that's what they will try first. Eventually, that may lead to a collapse, a deflationary collapse, as you put it. But I think that they will try the easy way first. Dennis, I don't like any of this. I'm just telling you how I see the facts.
Yeah, well, and then I know the listeners and I all appreciate your opinion. Let me ask you this, Jim, just from a little different angle here. The de-dollarization movement around the globe seems to be intensifying, particularly with the BRICS countries. Now that Saudi Arabia and you've got United Arab Emirates and Iran all part of BRICS. To what extent do you think the dollar is now threatened as the dominant reserve currency around the world?
Well, again, I don't like saying, but it seems to me that Washington is accelerating that move. If Washington gets angry at you, they cut you off from using the international currency. I mean, an international medium of exchange, Dennis, is supposed to be neutral. Anybody can use it for anything. But in Washington, they don't play that game anymore, or they don't play by those rules. Now, if they get angry at you, they cut you off. Well, needless to say, even our friends are starting to say, wait a minute, they could do that to us too. We better start looking for a competitor. And so most of the world is now looking for something to compete with the U.S. dollar and use instead of the dollar. And Washington is accelerating it. I said, they're not very smart people.
Yeah, I agree. I'm chatting today with Mr. Jim Rogers. He's author and investor. Jim, as you move ahead here, we've seen the metals markets really react to this or to something anyway. Do you think that that's the safe haven that investors should be looking at as this de-dollarization trend and this currency creation trend continues?
Well, I have silver, I have gold, and have had for years. If they go down, I hope I'm smart enough to buy more. For hundreds of years, people have resorted to silver and gold, precious metals, when things are bad. I suspect they will again. I don't see anything else that the whole world accepts and understands besides silver and gold. If you know something it may be wheat, but wheat's a little complicated for people like you and me, simple people, or whatever term you use. So I suspect, to repeat, I'm going to buy more silver and gold if I get it right.
Do you have a forecast for both silver and gold moving ahead, Jim?
Well, I'm going to buy them because I think they're going up. And normally when things get bad, Dennis, as you know, sometimes things get out of control. Absurd things happen. I can remember when silver was $50 an ounce. That was 40 years ago, $50 an ounce when things got so bad. So if they get bad again, I'm sure silver will certainly make new highs. Gold is already making new highs. No, all of us peasants, I'm an old peasant, and all of us peasants know we better get some more gold and silver if the world's collapsing.
So what does Jim Rogers think about Bitcoin and perhaps other cryptocurrencies?
Well, I know people who've been trading them and making money. Several cryptocurrencies have already disappeared and gone to zero, as you know. But as trading vehicles, go to it if you're a good trader, and some people are. The optimists say they're going to be the new currency. I don't see that that's going to happen because nearly all governments are working on crypto money now. Everybody wants to have money on the computer. Governments love it. It's cheaper. It's more efficient. And they know everything about you. They'll call you up one day, Dennis, and say, Dennis, you've been drinking too much coffee this month. Cut down on your coffee. They will love to know everything you do. I don't like it, but they love it. So it's coming. No question that computer money is coming, but whether it's going to, I don't see when Washington says, okay, guys, this is money now. But if you want to use that money, you can use that money. I don't see Washington bureaucrats and politicians accepting and encouraging competition like that. They want control, they want regulation, and they have the guns. I don't have any guns to stop them.
So do you think so you're of the opinion that the governments will be successful in rolling out a central bank issued digital currency? And if I'm not putting words in your mouth again, what do you think the time frame might be?
Well, China's already there. If you go to China, you can't buy ice cream. You have to buy ice cream with your crypto money, with your computer money. You can't take a taxi in China. So they're ahead of it. They're already there. So I suspect it's going to happen to everybody for the reasons I said before. They love it.
So, Jim, what's your forecast in the time we have left in this segment? What's your forecast for stocks moving ahead?
Well, stocks have been having a very good time since 2009. I am not selling short yet because I see excesses developing. I see problems starting to develop, but they're not so excessive yet that it says, hey, you got to get out of this. This is now crazy. So I would suspect that the bull market is not over. It will probably be over in a few weeks or months, but I'm not selling short yet.
If you look at what has happened to U.S. government bonds over the last couple of years since the Federal Reserve has been increasing interest rates, top to bottom, more than 50% on a 30-year U.S. Treasury bond. What's your forecast for U.S. Treasuries moving ahead?
Well, as I'm old enough to remember that in my lifetime, when Treasury bills yielded 21%, that's not a typo, 21% for U.S. government Treasury bills. So I know that interest rates will go much higher before this is all over because the money printing this time around has been so staggering everywhere. The borrowing and spending has been so staggering everywhere that interest rates before this is over are going to be much higher.
Well, I'm chatting today with Mr. Jim Rogers. He is an author and an investor. The good news is I'm going to have Jim back for another segment, so stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program is returning guest, Mr. Jim Rogers. Jim is an author and an investor. He was on the program a couple of years ago, and he joins me today from his offices in Singapore. And Jim, let's just go back to what you mentioned in the first segment. You suggested that you are starting to see some potential problems developing that would indicate that maybe some trouble does lie ahead. Could you maybe give us a couple examples as to what you're seeing?
Well, you're starting to see new investors come in. They call up their friends and they say, I've discovered this thing called the stock market. It's fun and you can make money and it's easy. It's easy to make money in the stock market. I mean, you've seen this rodeo before. I've seen this rodeo before. This happens towards the end. Everybody gets excited and exuberant and they go down to the restaurant or the bar and they hear these hot stories and they get excited and they jump in and it ends badly before it's over. And then that generation says, I'm never going to invest again. They're liars and cheaters. It's rigged. It's a hopeless game. Stay away. And then, a few years later, Some others come back, their kids come back, the new generation to say the same things. And I'm hearing those stories already.
So, Jim, if I'm hearing you correctly, you're suggesting that stocks likely are going to go lower at some point, maybe not immediately, but at some point in the near future. You expect interest rates to go higher. That's bad news for bonds. What is Jim Rogers' favorite asset class at this point?
Oh, I guess my favorite eventually, I hope, will be selling short, but I'm not doing that yet. I guess right now, probably agricultural commodities are good. Those are still cheap. I mean, Dennis, in the last several years, nobody wants to be a farmer. Everybody wants to go to Wall Street. I've seen this movie before too. But we got to have food, we got to have clothes, and agriculture has not been a great boom for a good while yet. So I would say agricultural commodities, maybe silver. I own silver, and silver's down 50% or so from its all-time high. So maybe silver, agriculture, things that are depressed.
So, Jim, if agricultural commodities are bullish, do you see farmland also following suit? And would you be bullish on farmland?
Well, farmland is and has been and is a good investment unless you get over leveraged or something. So no, of course. But Dennis, I urge you not to buy farmland if you don't know what to do with it. If you don't know how to be a farmer, you're probably going to lose a lot of money. And you'll say, I saw Jim Rogers say farmland's a good investment, and I went broke. So you better know what you're doing if you buy farmland. And there are certainly good farmland bargains around the world, Canada, Australia, US. There are places that farmland is cheap.
So
Russia, you could buy farmland in Russia very cheap now. I'm not. There's a war, but there is cheap farmland in the world.
So how do you read commercial real estate? All the refinancing that's got to take place here in the next 9 to 12 months at much higher interest rates. Commercial real estate's already suffering, hurting. More downside here, in your opinion, or where does it go?
Well, Dennis, it sounds like you've seen this movie before, too. There's gigantic debt in that sector. And that many things have to be renewed in the next few years. It has always led to problems. If you have the combination of higher interest rates, excess capacity, and slowing economy, slowing consumption, that is not a pretty picture. Never has been.
So, Jim, how do you read inflation, particularly as it relates to the U.S. economy, very much a consumer spending dependent economy? I think the last numbers I saw were between 1.3 and 1.4 trillion on credit card debt. Consumers really seem to be pinched at this point. Have they reached a breaking point that it's really going to be, the catalyst for the next leg down here in the U.S. economy?
It always has. As I said, I've seen this movie before. And maybe somebody's going to tell you, oh, it's different this time. Well, as you know, Dennis, when people tell you it's different this time, run as fast as you can, because it's not different. Everything you just described has always led to problems. And I don't see anything that is different this time. The names are different. The places are different, but no, this has always led to problems. You and I can see the same things. Look out the window. It's all developing the way gigantic problems have developed in the past.
So, Jim, do you see residential real estate following stocks down when the downturn does start?
Well, yes, it will. But if you have bought your home or your residence, paid the proper price in a good location, you're not going to get destroyed. Some speculators will get destroyed, of course. But if you've done a proper job of buying your home and paying it without a huge debt, you're probably going to be okay. Your neighbors are going to suffer, prices will suffer, but you don't have to get wiped out.
So, Jim, what do you make of the most recent GDP report we saw here, where the U.S. economy, I think GDP growth was cut to like 1.6%? Is that the beginning of this downturn, or is it too early to tell?
Well, it's always too early to tell until it happens. As,
Yeah.
as you know, I hope you have enough experience. But those are the early signs that usually develop when we're going into a slowdown. I mean, it works that way historically. So something small happens over there that we don't pay too much attention to, and then something over there might happen, and people will really not pay a lot of attention. But 9 months later, it's on the evening news, and everybody knows there's a big problem. It develops slowly and in small ways, in places where we don't pay attention, but it eventually, everybody knows.
Jim, I've had other guests here on the program that have forecast that what lies ahead here at some point will rival what we saw in the 1930s. What would you say to such an analogy?
Well, I've already said it's going to be the worst economic problem in my lifetime. And I think I'm older than you, Dennis, so it'll be the worst in your lifetime, too. Whether it's the 1930s or not, I don't know. It's going to be bad enough that people don't care. It's going to be plenty bad. So whether it's the 1930s or whatever, the 1890s, people won't care. They'll just know it's really bad and this is not fun.
So are you thinking we're going to see unemployment levels, real unemployment, not necessarily the reported unemployment? That's another show in and of itself. But do you think we're going to see, reported unemployment or excuse me, real unemployment back up in the 20% range?
I don't know. I know that when things start going bad, Washington's going to panic and do everything they can to help us, to quote, help us. That's their version of help us. And it's going to be very bad. As I said before, last time around, Treasury bills yielded 21%. Unemployment was high. People were going bankrupt. So whatever the comparisons, they're not going to be fun. And most of us are not going to care whether it's like X year or Y year. We just know it's bad.
So, Jim, I have time for one more question. If somebody's listening to this and they're really concerned, their goal is to have a retirement, they've been working hard their whole life to try to save, what advice would you give them to prepare for what you believe lies ahead?
Well, we've mentioned silver and gold. I own some silver and gold. That may or may not be an answer. But the best answer, Dennis, is just put your money where you yourself understand what you're doing. Don't listen to some guy down at the bar on Saturday. Don't listen to a hot TV show or internet show. Just stay with what you know. Everybody listening to this knows a lot about something, whether it's cars or fashion or something. If you stay with what you know, you will be okay. Maybe you won't make a lot of money, but you certainly won't get destroyed. Stay with what you know. Don't listen to hot tips. Do not listen to hot tips. Just stay with you at your own area of expertise, and you will come out okay. You might even make money. I mean, in the 1930s, there were people who made fortunes who knew what they were doing. Even in their 20s, in the big collapse in the early 20s, there were people who got really rich. Those were people who knew what was happening, understood what was happening, and participated because they understood. Be one of those people.
Well, that is terrific advice. And on that, we're going to have to leave it there. My guest today has been Mr. Jim Rogers, author and investor. Jim, thank you for being so gracious with your time once again and joining us here on RLA Radio. Love to have you back down the road and appreciate you being here.
It's always fun, Dennis. I look forward to another time. Thank you.
We will return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Glad you're listening in today, and thanks again to my special guest, Mr. Jim Rogers, for joining me on today's program. If you have not yet requested my May special report titled Probate Avoidance Guide, I would invite you to go to requestyourreport.com and do so. When you visit requestyourreport.com and request your copy of the Probate Avoidance Guide, I'll be glad to send you a copy of my best-selling revenue sourcing book, as well as the little black book on Social Security maximization. All that information is free and without obligation. Just visit requestyourreport.com and I will send it all to you. In the first segment of today's program, I talked about the recently issued trustee report of the Social Security program. The trustee report, signed by Janet Yellen, who is the Treasury Secretary, as well as the Acting Secretary of Labor, as well as the Secretary of Health and Human Services, says that the Social Security Trust Fund will not be there in 9 years. Now, at that point, Social Security, based on current tax revenues, will have enough revenues to pay about 75% of promised Social Security benefits, and that is according to the assumptions in the trustee report. Now, as I talked about in the first segment, some of these assumptions are a bit optimistic in that the report assumes the fertility rate will be 2.1. That's 2.1 children born per woman. The number actually just hit an all-time low of 1.6 or 1.6 children born per woman last year. That will certainly affect negatively the number of future workers paying into the Social Security program. The report also assumes productivity growth will average 2%. Last year was just 1.3%, and in 2022, productivity actually shrank by 1.9%. So there are a lot of rather rosy or optimistic assumptions behind this rather grim outcome. Now, when you look at what are politicians doing about it, the answer is not very much. The Biden administration released a report, and their statement says, quote, Social Security remains strong. And if you'd like to get a link to read that report, you can go to retirementlifestyleadvocates.com, click on my newsletter dated May 13 of 2024, and I've got a link in my newsletter to the report. Now, when you read the report, when you read the statement, Biden is proposing making Social Security stronger by making the wealthy pay their fair share. And I started to talk about this in the first segment of today's program. The current annual outlay for Social Security, when you look at the numbers, it's just about $1.4 trillion per year. In 9 years, as I said, there will be enough Social Security tax revenues to pay 75% of promised benefits. And again, that's based on some rather optimistic assumptions. So what does that mean? Well, that means there will be a shortfall of about $350 billion per year. Now, if you take $350 billion and add it to the current operating deficit of the United States of about $2 trillion a year, and you add that shortfall to the interest on the debt that will reach $1.6 trillion annually by the end of the year, it's about $1 trillion now, you get an operating deficit of $3 trillion a year if Washington doesn't come up with new programs. Now, making the wealthy pay their fair share sounds like potentially a good idea to some of you listeners. However, there's not enough wealthy people to solve this problem. Many politicians have thrown about the idea of a billionaire tax. Well, I've done the math, and confiscating 100% of the wealth of billionaires doesn't even solve the deficit problem I just described for 1.5 years. So yes, we can put them all in the poorhouse, And in less than 18 months, we now have the same problem. Now, it's interesting how this problem is really being ignored, not only by many politicians, but also by many publications, including publications that have historically been more conservative-leaning publications. The Wall Street Journal recently published an article basically saying that Social Security's rapidly depleting trust funds are no big deal because Congress can always just choose to continue funding the program. Here's my question. With what money? As I just outlined, the budget deficit is already $2 trillion a year. So if Congress chooses to continue paying out 100% of Social Security benefits after 2023, how is it going to be funded? With more debt. The Journal article then suggests that such spending, quote, could also mean the U.S. deficit continues to grow at a pace economists find alarming, potentially weighing on the performance of the economy, end quote. I find it interesting that they say it could also mean the U.S. deficit grows. Potentially is the other word I find interesting, weighing on the performance of the economy. So in what reality does a multi-trillion-dollar deficit and a fully depleted Social Security trust fund not weigh on the U.S. economy? It's really amazing that a lot of this reality is not being discussed and addressed. Here's the reality according to the report. Social Security will run out of money. Benefits are at risk. And the only way to save the program is more debt, which means more inflation, which means more risk to the dollar's global reserve status, which is already losing status at an accelerating rate, and more consequences down the road. So what's going to happen here? How will this problem be solved? I don't know, but I believe short term, we'll see more debt accumulation funded through likely more currency creation, also known as quantitative easing. And if you're planning for retirement, what does this mean for you? It means, first of all, that you need to educate yourself. You need to use the revenue sourcing planning process when planning your retirement income. And one way to learn about that is to request this month's special report, because when you request that report at requestyourreport.com, I'll also send you a copy of the revenue sourcing book, and the planning strategy that I am discussing here is outlined in great detail in the revenue sourcing book. I'll also include with that package of information that I send you a copy of the Little Black Book on Social Security Maximization. I'll also include a couple recent newsletters. So again, just go to requestyourreport.com. I'll be very glad to send you all that information. Again, the website is requestyourreport.com. There are also plenty of free resources at retirementlifestyleadvocates.com. You get the newsletter I referenced earlier in this segment there. Also, the replay of the Headline Roundup newscast I do every Monday noon live. Again, that is at retirementlifestyleadvocates.com. That's all the time I have for this week. Glad you tuned in. I'll be back again next week.